Okay, ladies and gentlemen, thank you for coming to this early class. Let's start. So last time I showed a simplified timeline of the last financial crisis in 2007-2008. So today let's look at each phase in more details. The phase one of the crisis was the collapse of the subprime mortgage market and the mortgage-backed securities market. So in 2007 in the United States, the first 6 months were pretty normal, and we see the seeds of the crisis, they say, only when we look at the subprime mortgage related markets. So let's look at the seeds of the crisis. So this figure shows the HBX-HE index, Asset-Backed Securities Index for home equity, published by the financial data company Market. And yeah, remember what index is. We started index in week 8. So index is the price of a particular portfolio. Yeah? And HBX-HE index is the price of a portfolio of 20 different subprime mortgage-backed securities for £1, 100 principal, 100 pound or dollar. And the equal weights are, portfolio weights are equal weights. Okay? So HBX, index, it is available, this index is available for a variety of rating tranches. So remember, even if the underlying assets are subprime mortgages as opposed to prime mortgages, so the borrowers aren't great, based on the pool of the subprime mortgages, in theory, they can still issue highly rated securities using tranching and credit enhancement. Okay? So HBX index for AAA is the price of a portfolio of 20 different subprime mortgage-backed securities, which were rated AAA at the beginning of 2007, and HBX-HE index for BBB is again the price of portfolios of 20 different BBB rated subprime mortgage-backed securities. And as you can see, until the end of 2006, even lower tranches, like junior tranches and equity tranches, had pretty good price. The price was something like 98 or 99, which means that even these lower tranches were considered safe. The first shock hit in January 2007 when lower tranches started to drop in value. Still, the highest two highest tranches were still fine. They kept a good price. The second shock hit in July 2007 when investors realized that even these highest tranches were crap. And this deterioration of the subprime mortgage-backed securities market affected other financial institutions because financial institutions were using these securities heavily. Commercial banks were affected by this because they were doing asset-backed commercial paper programs. So commercial banks set up conduits, and the conduits acquire a lot of long-term mortgages, loans, receivables, and long-term asset-backed securities, CDOs, asset-backed bonds, and they were funding these assets by short-term money from investors, right? By issuing these short-term bonds, discount bonds called ABCP. In August 2008, the French bank BNP Paribas closed 3 of their funds, money market funds, which were heavily investing in ABCP. Clearly, BNP Paribas must have known about the qualities of the ABCPs these funds were investing, They must have known that these ABCPs weren't great. Probably that's why BNP Paribas closed their own funds. So this sent a very bad signal to the ABCP market investors, and the run on ABCP started in August 2007. This is the first panel, shows the total amount of asset-backed commercial papers outstanding. And as you can see, till August 2007, it kept increasing. But in August 2007, the amount dropped, which means that investors no longer buy as much ABCPs. So these conduits had trouble in issuing new ABCPs when old ABCPs matured. This last panel shows the average maturity of newly issued ABCPs. So prior to August 2007, the average maturity was 1 month. So ABCP investors were okay with lending their money to conduits for 1 month. But in August 2007, the average maturity dropped to less than 2 weeks, which means that even investors who continued to lend to conduits, relatively okay conduits, didn't want to lock up their money for more than 2 weeks. Panel B is also another evidence of the run on ABCPs. So this is the interest rate implied by the price of the ABCP minus some risk-free rate. Prior to August 2007, the interest rate, the yield of ABCPs was around 0.1%, which means that the price of ABCPs was pretty high. But in August 2007, the interest rate soared, which means that the price of the ABCPs dropped sharply. About 1/3 of the ABCP programs had trouble in rolling over their ABCPs. Okay? But still, because commercial banks were giving explicit guarantee to the ABCP investors, most of the ABCP investors didn't make much loss. Okay, those are commercial banks. But commercial banks weren't the only banks that were using these long-term asset-backed securities for shadow banking. Investment banks were also doing a shadow banking called securitized banking. They were funding long-term mortgage-backed securities such as CDOs by borrowing short-term money from investors through repos. And the repo market also started to collapse in August 2007. The evidence is repo haircut. And remember what repo haircut is. If I have an asset, let's say I have an asset which is worth 100 pounds now, and suppose I use this asset as a collateral to borrow money from you. Suppose you lend me 90 pounds using this asset as collateral, and the price of the asset is 100. What is the haircut in that case? If the borrowed amount is 90 pounds and the value of the collateral is 100 pounds, the haircut is 10%. Okay? Which makes this lending safer. Now, if the price of the asset is very stable, then the haircut can be very low. If the price of the asset has been fluctuating, is very volatile, then the required haircut can be very large. Because, within 1 month, the price of the collateral can drop significantly. Prior to August 2007, the repo haircut was very low, like 0.1%. Which means that if an investment bank had an asset which was worth 100 million pounds, they could borrow, using such an asset, they could borrow 99.9 million pounds from investors. In August 2007, the repo haircut started to increase, clearly because the price of these highly rated tranches, the price was very stable before, but now it's more volatile. So the repo haircut consequently increased. And by the end of 2007, the repo haircut was nearly 10%, which means that with an asset worth 100 million pounds, investment bank could borrow only 90 million pounds. Okay, which was double blow for investment banks because well, the price of the asset dropped, first of all, and on top of that, they could borrow less due to the higher haircut. This hurt investment banks such as Bear Stearns, Merrill Lynch, and Lehman Brothers. Back then, Merrill Lynch was number 2, Bear Stearns, Lehman Brothers was number 3, and Bear Stearns was number 4. Goldman Sachs number 1. Now, commercial banks and investment banks were not the only financial institutions that were affected by the deterioration of the subprime mortgage-backed securities market. Some insurance companies and government-sponsored companies were also severely affected. Monoline insurers are the insurance companies that focus on insurances against default. So they don't sell any life insurance or health insurance or property insurance. They sell insurances against defaults of securities or companies. These insurance companies were mostly rated AAA before the crisis, and they were selling a lot of insurances against these tranches, higher tranches of subprime mortgage-backed securities, and because the prices of these, because many of these subprime mortgages defaulted, they had to pay, these insurance companies had to pay a lot of insurances, and consequently, they were significantly downgraded, which in turn led to the downgrading of many other bonds and securities insured by the same insurance companies. Think about your bond. Let's say your own rating is single A. Even if your own rating is single A, you can still issue a AAA rated bond if you have a AAA rated rich uncle and your uncle serves as a guarantor of your debt. So if you default, if you cannot repay, your uncle will pay. In that case, your bond can be AAA rated. Even if some local governments didn't have AAA rating, still they could issue AAA rated bonds if they paid some fee to these AAA rated insurance companies to get some credit enhancement. Yeah? If your uncle, however, loses his job and becomes poor, then your bond consequently gets downgraded. Similarly, when these insurance companies got downgraded, these bonds were also downgraded significantly. And remember, for bonds and securities, getting AAA is important because there are many institutional investors like pension funds that invest only in safest securities. As long as an asset bond has AAA rating, it has very high demand. It can be sold for very good price. Once it gets downgraded, these institutions have to sell these securities, so the demand and the price significantly drops. Okay, so these other bonds were also affected by that. Government-sponsored companies are not regular companies. They are sponsored by the government. Their bonds are called agency bonds. Agency bonds are not as safe as government bonds, but they are considered much safer than normal companies' bonds because the chance of the government taking the responsibility, the chance is high. Okay? Fannie Mae and Freddie Mac are government-sponsored companies. Their role is to acquire a lot of mortgages, prime mortgages and subprime mortgages, bundle them, combine them, and slice them to issue mortgage-backed securities such as asset-backed bonds and pass-throughs. When the mortgage market collapsed, well, sometimes in issuing such securities, they act as a credit enhancer. They give guarantee. So when the mortgage market collapsed, these companies made a lot of loss. So these companies were, the default risk, the bankruptcy risk of these companies went up, and consequently the prices of their bonds continued to drop, which also affected other money market funds and hedge funds that were heavily investing in these agency bonds. And it's important because it led to the default of the fourth largest investment bank, Bear Stearns. So in March 2008, Bear Stearns, which was the fourth largest investment bank back then, went bankrupt. It was an investment bank, so it made a lot of loss from the repo market. Bear Stearns was also investing a lot in the agency bonds, and they were also investing in other hedge funds that were heavily investing in agency bonds. So there are several reasons, but anyway, Bear Stearns went bankrupt. But it was bought by JP Morgan Chase, which created too big to fail argument. Basically, it was saved by the government. So at this point, let's be sure that we have at least a rough idea of what saving a company means. When a company goes bankrupt, obviously the shares of the company become trash, rubbish, okay? But shareholders are usually more ready for that than creditors because they usually diversify their portfolio. If a company is liquidated, the company's assets, securities, properties, equipment are sold out in the market to other companies. And depending on at what price the assets are sold out, the creditor may recover maybe 90% of their debt or maybe only 50% of their debt, making a lot of loss anyway. If the company is somehow rescued, however, the shares become trash anyway. The shareholders make a lot of loss anyway, but the creditors will be mostly saved. Okay, that's what saving a company means. The creditors are saved. So creditors don't make much loss. In this case, JP Morgan acquired Bear Stearns, which means that JP Morgan inherited the assets of Bear Stearns, and they took over the debts of Bear Stearns. And it's usually better if a competitor or some other company in the same industry acquires Bear Stearns. That company can utilize the resources of Bear Stearns, so the value is higher than when the assets are sold out in the market for liquidation. However, obviously, by acquiring Bear Stearns assets, JP Morgan is taking over its debts, and JP Morgan wouldn't want to do that if the benefit of acquiring the assets of Bear Stearns is smaller than the cost of taking over their debts. But at the point of bankruptcy, when a company goes bankrupt, at the point of bankruptcy, it's impossible to accurately evaluate all the assets and debts of the company. So the JP Morgan would want a guarantee from the government or the central bank to the extent that they wouldn't make a loss from this deal. Okay? And the US government or the central bank, Federal Reserve, provided that guarantee, and therefore it wasn't just JP Morgan, but the US government or the central bank that saved Bear Stearns. Does that make sense? Okay, that was March 2008, and the worst phase of the crisis arrived on 15th of September 2008 when the third largest investment bank, Lehman Brothers, declared bankruptcy. And if you watch the film Inside Job, one of the criticisms they make against the government and the regulators is, what were they doing between March and September? But anyway, so they couldn't prevent this. Lehman Brothers went bankrupt, and against many investors' expectation, Lehman Brothers was not saved. It simply disappeared. The number two investment bank, Merrill Lynch, also went bankrupt, but this one was bought by Bank of America, a big insurance company that made a lot of loss by selling credit default swaps, also went bankrupt, and this one was bailed out by the government. But Lehman Brothers was not saved, and it caused a lot of shock. It affected first the money market fund market. One of the oldest and largest money market funds, named Reserve Primary Fund, was investing a lot of money in the commercial papers issued by Lehman Brothers. And they made a loss when Lehman Brothers defaulted, and they broke the bank. Their share price went below $1. We don't know why Reserve Primary Fund was investing so much money in Lehman Brothers commercial papers. Maybe the credit rating of Lehman Brothers wasn't so bad even 1 month before the bankruptcy, or maybe Reserve Primary Fund was expecting, as many other investors did, was expecting the US government or the central bank would save Lehman Brothers. But anyway, they made a lot of loss, and they broke the bank. Money market funds breaking a bank was a very rare event. So prior to the crisis, in the history of US money market funds, only a few money market funds broke the bank. So when Reserve Primary Fund broke the bank, other money market fund investors became really concerned. Okay, one of the oldest and largest money market funds broke the bank. Is my money market fund fine? Maybe we should withdraw money from our money market funds before they break the bank. So for the following 3 days, many investors withdrew their money from money market funds. They withdrew about $210 billion US from money market funds. In the end, on 19th of September, 3 days later, the US government announced a temporary deposit insurance. So money market funds are shadow banking, so they are not insured by deposit insurance, but the US government announced a temporary deposit insurance. So the investors eventually stopped withdrawing, so the panic subsided. But this three-day panic was enough to affect other markets. The commercial paper market was also affected. Commercial papers are discount bonds, short-term discount bonds issued by large famous companies. They are not coupon bonds. They are not secured by any collateral. They are just short-term discount bonds. Commercial papers are just short-term bonds, discount bonds, with time to maturity such as 3 months or 6 months. Very short. And only large famous companies like, I don't know, the McDonald's, or Microsoft, or British Airways, these companies, famous companies, can issue such short-term bonds, and usually they are considered safe. The collapse of the default of Lehman Brothers commercial papers itself was a bad news for the commercial paper market. But on top of that, during these 3 days of run on money market funds had to sell a lot of commercial papers. So when many investors came to withdraw their money from money market funds, behind that, the money market funds had to sell a lot of commercial papers to make redemption to their investors. So a lot of commercial papers were sold, and consequently, their demand and prices dropped sharply. So this is the evidence of the collapse of the commercial paper market. So this figure shows the total amount outstanding for both for the asset-backed commercial papers and for non-asset-backed traditional commercial papers. So this black line is the total amount of ABCPs outstanding, and as we studied, the ABCP market collapsed in July 2007, but still, the traditional commercial papers were fine. Okay, when the ABCP market collapsed, maybe the traditional asset-backed commercial paper market also was affected, but it recovered soon, and traditional commercial papers were fine until September 2008. But in September 2008, the commercial paper market collapsed. So basically, when all the commercial papers matured, these companies could no longer issue new commercial papers. These companies could no longer roll over their short-term money from investors by issuing new commercial papers. So these companies had to turn to their banks to get short-term money. Okay, if they cannot borrow short-term money directly from investors, they had to turn to their own banks to get short-term funding. So let's look at bank lending. This diagram shows new term loans and new credit lines. So when a bank says, okay, company, we can lend you this much loan starting next week. That's new term loan. Okay? That's this black line. That's black line. If the bank says, okay, company, we can promise to give you a loan if you make a request within 2 years. That's not yet loan, that's new credit line. That's a promised loan or loan commitment, which is this dotted line. By the end of 2007, the commercial banks were already in trouble from ABCP programs. So it is not very surprising that they had already started to cut their lending. They both newly made term loans and newly promised loans started to drop by the end of 2007. Yeah? But if we look at the total amount of bank lending, which is this dotted line of the second figure, the total amount of commercial and industrial loans made by banks actually shows a sharp increase in September 2008. At the first glance, this is puzzling. Why would banks want to expand their lending in the middle of crisis when they were short of cash? The reason becomes clear if we look at the total amount of commercial papers outstanding, which is this black line. So as we saw in the previous slide, in September 2008, as the consequence of the run on money market funds, the commercial paper market collapsed. These companies could no longer borrow short-term money from investors directly by issuing commercial papers, so these banks had to borrow from banks. So they simply decided to take down the promised loans. Usually, even if companies buy loan commitments, promises from banks, not all companies actually take down the promised credit lines, but back then, well, because they couldn't issue commercial papers, and also the company's future was uncertain, the bank's future was uncertain, and the economy's future was uncertain. So many of these companies simply decided to take down the promised credit lines, okay, promised loans. The recession had already started, so many of the loans were something that the banks didn't want to provide, but they had to because they had promised. Now, as we studied in week 3, the liquidity risk for banks, the cash shortage, the risk of cash shortage for banks comes from two sources, one from the depositor side, the other from the borrower side. If many depositors suddenly come to the bank to demand their deposit back, that's bank run, the bank will experience a cash shortage. That's one source of liquidity risk for banks. And another comes from borrowers. If many companies suddenly decide to take down the promised loans, the promised credit lines, then the bank has to provide these loans because the bank promised, and that's another source of cash shortage. Okay? And that's what happened at this time. And we come to this interbank market. Both commercial banks and investment banks had made a lot of loss from ABCP programs, repos, and Lehman Brothers collapsed, and it wasn't even saved by the government. So suddenly, in September 2008, commercial banks and investment banks became really nervous about the creditworthiness of other banks. There must have been some banks that were fine, but they didn't know who was fine and who was in trouble. They didn't know how much losses other banks had made. They didn't know how much ABCP programs and repos other banks were doing. They didn't know how much derivatives other banks were trading, and they didn't know how much loan commitments other banks had. So they suddenly all banks became very reluctant and unwilling to provide loans, even short-term loans, to other banks, and consequently the counterparty risk in the interbank market increased, and the LIBOR soared. So the second diagram shows the LIBOR-OIS spread. That's an indicator of the counterparty risk in the interbank market. The LIBOR was very small prior to July 2007. It was around 10 basis points, that's 0.1%. In July 2007, it increased to the level of 100 basis points, 1%. And it was around 1% till September 2008, but in September 2008, after Lehman Brothers went bankrupt, the LIBOR soared to 3.5%. And this means what? This means that for example, for Citigroup to borrow, for Citibank to borrow money from Goldman Sachs for 3 months, the annual interest rate was 3.5%. Okay? So the interbank market almost froze. The banks didn't lend to one another. But the interbank market, in the context of financial system, the interbank market is like the riverhead, the source of water for the rest of the river, right? It's the bank's ability to be able to borrow short-term money from other banks is very important in order not to affect other businesses, the rest of the economy. So central banks all over the world quickly jumped in, and by printing a lot of money, the central banks all over the world injected a lot of money into the financial system. They lent a lot of money into financial institutions. So the most dangerous phase passed relatively quickly, but still the impact on the rest of the economy was massive. Many companies couldn't borrow money. Many companies went bankrupt. Many people became unemployed, and low growth, high poverty, and so on. Actually, it was still really bad, even at the beginning of 2009. Okay? Now, the film, the Inside Job. This is a very good film. You should definitely watch it. It's also very fun. It's very good, except that at the beginning of the movie, they misspell the names of 2 key persons, but except that, I think it's very good movie. The film focuses on the first 2 phases of the financial crisis. Okay, there was unwise deregulations, there was moral hazards by investment bankers, there was professional negligence by credit rating companies, these things, and microeconomists are interested in this part of the crisis, that is how asymmetric information can cause adverse selection problems and moral hazard problems in banking, and how it can make the financial sector fragile and how it can be amended. Macroeconomists are more interested in the later phase of the crisis, the contagion part. After all, when it started, it was just the collapse of subprime mortgage market. And the subprime mortgage market is just a part of the entire financial system. How could it lead to the collapse of other things like money market funds, commercial papers? How could it affect interbank market, stock market, and the rest of the economy? So macroeconomists are more interested in that. So when you revise, first understand all the building blocks, and then watch the film and revise the contents of today's lecture, understand how it happened and why it happened. And then we don't have, for this module, we don't have time to study how to prevent financial crisis. But if you listen to the book by Martin Helwig, and the book proposes a solution. And after doing everything, you will feel confident. You will feel that you have learned, understood solid basics for the banking and financial system. Okay? And after that, you should be able to understand all these articles like Financial Times. The university has subscription to Financial Times, the online version. So you can read the articles with your smartphone or computer. So do that, especially if you're interested in applying for companies in the financial sector. Okay? Any question? Okay, then thank you for coming, and let's see you next week.